Hello, and welcome to our channel Pursuit of Wealth. This channel is your ultimate destination for learning about finance and wealth, investing in crypto, informational and educational trends in finance management. If you are someone who wishes to become wealthy and are looking for smart money management options, then we are fortunate to have found each other. Stock markets are also like human investors that compose them. The market is considered mortal because sometimes it dies in a spectacular and bloody fashion. That's why investors are always worried about their investments. Their investment can bring them profit as well as loss. While investing, it's always advised to do proper research at first. Well, in today's video, we are going to discuss some important metrics that are used to examine a stock. These metrics are the signs of a market rise or fall, and the market never crashes overnight. It falls with momentum. If we start observing all the previous market crashes, we will get enough insights that there have always been signs indicating a market crash. Well, we have brought you a list of signs that are pretty common behind many market crashes. So stay tuned until the end to find out. For being aware of the market crash, you need to stay mindful of the stats of the markets, which indicates the market fall. The investors who don't care about the overall start end up facing a huge loss. Here are the signs that show a market crash and can also predict many things about it. Number 1. Rampant speculations. The first sign indicating a market crash is rampant speculation. Rampant speculation symbolizes that the positive feedback loop is expanded in the market. This means that stocks are currently at their higher value. The current value of the stock is much higher at the moment, so the stock is overvalued. The higher prices of stocks predict the rising importance of stocks in the future. The majority of the investors take the rampant speculation as to the most promising sign of market downfall. Such minor indicators lead to massive declines. A market crash is surely near when overvalue of the stock continues for an extended period. The collapse in the stock prices is so sudden during the market crash that it's impossible to recover in such a short time. The safest method is to take precautionary measures as soon as one notices rampant speculation. You won't make much profit with this, but at least a lesser profit is much better than a huge loss. So, it would help if you never ignored rampant speculation. Number 2. A high cyclically adjusted price-to-earnings ratio. The next sign in the list indicating the market crash is the cyclically adjusted price-to-earnings ratio. This ratio evaluates a company's profitability in proportion to its share price, is a 10-year moving average of the classic price-to-earnings ratio, and is also written as CAPE. This metric has been used for more than 2 decades to evaluate the stock. It came onto screen in 1996 by Robert Shiller. It is also known under the name of Shiller price-to-earnings ratio. This method efficiently ignores the little ups and downs in the history of stock in the last 10 years. In this way, we know that the stock is genuinely overvalued or undervalued. A healthy CAPE is between 15 and 16. Anything beyond 20 is a reason for alarm, and when it approaches 30, it's a sure indicator that something significant is on the way. The CAPE of the S&P 500 index went as high as 33.1 in the years leading up to the anxiety. Number 3. Overvalued assets. Not only overvalued stock, but overvalued assets indicate market crashes too. Seeing the stock successes and growing economy, investors start investing in other high assets too, considering it their good luck, which is alarming. During overpricing, the price of collectibles will also be high. You have to be aware of promoters. They will try to deceive you by the flourishing sports cars to invest in or the never-declining master-level arts. Such assets are useless to buy. They generate no cash flow. This will be so much a headache that you have to deceive someone who can pay more for the respective asset than you did. Some investable assets include shoes, handbags, video games, NFTs, etc. An example of an investable asset is cryptocurrency. People have been crazily investing in cryptocurrency. There's an identical situation with NFTs too. Cryptocurrency has made a revenue of $2 trillion till January 2022. Shoes and handbags have also been rising in price, just like digital assets. Number 4. Black swans. These are the unpredicted events that bring an enormous change in the market. Sometimes, these events are disastrous. The top listed black swans include the event on September 11, 2001. It was a terrorist attack that completely ruined the stocks. As hedge fund guru Burry can confirm, other dangers are hiding in plain sight, such as rising subprime mortgage defaults in 2007. In September 2008, these events resulted in the global financial crisis and the market's dramatic slump. Unlike white swans, black swans are said to be scarce. Identifying a black swan isn't an exact science, to be sure. It's a significant indication when official wisdom dismisses an evident and growing megaproblem. The official stance in 2007 was that the mortgage crisis could be controlled. The White House and the Federal Reserve claim that supply chain constraints caused by COVID-19 related labor shortages are temporary in 2021. But what if they're not? Number 5. Inverted yield curve. This is the situation where the interest rate on a 2-year Treasury bill is higher than that on a 10-year commitment. Of fact, the 10-year bond typically yields considerably more than the 2-year bond, since investors must be compensated for the risk of owning a longer-dated bond. However, when economic storm clouds gather, investors prefer to flock to the 10-year, viewing it as a safer haven. This raises the bond's price and, as a result, decreases its yield. In the previous 50 years, the yield curve has inverted before every recession, with only one false positive. The difference between 2-year and 10-year bonds has lately narrowed, although it remains about 1 percentage point. Number 6. An extended bull market. The market is considered a balanced system, but in actuality, it is everything but. The stock market battles to keep values in control from day to day, month to month, and even year to year, as bears and bulls dispute their positions. When the bulls seize control for an extended period, the price investors pay to own stocks skyrocket, resulting in excessive overvaluations. On the other hand, too much bear control sends stock values plunging, leading to severe undervaluations. Active traders make it their life's work to take advantage of the market's unstable equilibrium. According to Forbes, the typical bull market lasts roughly 2 years and 7 months. An extended run of the bulls might be an indication that we're about to see a turnaround. Number 7. Market sentiment is excessively positive. Emotion is a significant driver of stock market movement. When panic strikes, market prices fall as investors sell their holdings. When exhilaration and greed kick in, market prices soar as investors acquire shares. In some circumstances, emotions may run excessively high, forcing investors to throw all fundamental research out the window and make emotionally driven judgments that drive prices to extreme undervaluations or overvaluations. When the market becomes too enthusiastic and overvaluations become common, it is an indication that a crash is on the way. CNN Money established the index to identify whether investors are too bullish or highly bearish based on the 2 basic market emotions. The indicator was at 34 in September, indicating that investors are generally concerned about the market. With the market scared following a long-term greedy run and mood weighted down, falls may be on the way. Number 8. Weakening economic indicators. Economists utilize a variety of indicators to estimate the status of the U.S. economy at any one time, which is critical in evaluating if a crash is imminent. When economic conditions are bleak, investors tend to exit stocks. Many investors turn to the Conference Board Leading Economic Index, or LEI, which takes into consideration the following indicators. The credit index. Consumers are more inclined to take out new loans when they believe the economic conditions will make repayment relatively simple. They are less likely to borrow when the economic conditions are troubling. The performance of taxable corporate, fixed-rate, and government income securities is measured by the U.S. Credit Index, which helps gauge the economy's status based on fixed income returns. Yields on Treasury bonds. The LEI compares 10-year Treasury bond rates to the federal funds rate. The difference is that the premium investors are ready to pay for midterm Treasury bonds, reflecting investor attitude toward the U.S. economy. The housing market. Consumers are more inclined to acquire a new house if favorable economic conditions. As a result, if the housing market slows, including home sales, building permits, and new private housing units, the overall economy is likely to slow as well. Prices of stocks. The stock market in the United States and the state of the economy are highly correlated. The LEI considers stock prices in the S&P 500 index to evaluate how the market reacts to economic uncertainty. Manufacturing. When there is more manufacturing, it indicates that economic conditions are improving. The LEI monitors average weekly manufacturing hours and new orders for manufactured consumer goods, materials, and non-defense capital goods. Number 9. Long-term dovish monetary policy. Given that the stock market is, at its heart, a system that allows for the movement and balancing of cash and value, the Fed plays a significant role in market activity. When the Fed concludes that the U.S. economy is in jeopardy, it makes one of two main policy modifications, or a combination of them. Bond purchasing programs. The Fed trades liquid currency today for bonds with future maturity dates by acquiring enormous amounts of bonds. This fills the market with spendable money, encouraging the same frivolous expenditure that low interest rates sometimes encourage. The celebration, like low interest rates, does not go forever. The bonds acquired will eventually expire, but the Fed will likely reduce its bond buying activity even before that. Some Federal Reserve members believe that these actions will slow by the end of 2021. As a result, many firms anticipate lower revenues as consumers spend less, perhaps leading to a market meltdown. An investor is always mentally prepared to make profits or face losses. When any market crash occurs, investors become very cautious and live in fear of the upcoming market crash. But as soon as the market crash becomes old, investors start investing money carelessly. They don't even bother to look at the current position of their stocks. This makes them suffer huge losses. Market crashes are not good, but one can make money during this too. The only technique needed is to create a strategy before investing. If you are a beginner or an expert who has just faced a loss due to a market crash, both of you will be in fear right now. Just put it out and make yourself aware of all the current or upcoming market situations and stats related to it. So, that's pretty much it for the video. Hope you get all the insights about the signs of market crash that you should consider avoid facing loss. Don't forget to share your feedback and don't hesitate to ask questions in the comments section down below. Please subscribe to the channel, like the video, and press the bell icon for more amazing content about wealth management and finance-related videos. Success is coming your way. Keep your doors open. See ya till the next time.